Jai Hind everyone, welcome to my YouTube channel which is Explore Yourself, Banking and General Knowledge, etc. Today I will discuss some potential overseas posting examination questions and the corresponding sample answers for banks. Today marks part 16 of my Path to the Corner of this series for posting examination questions and the corresponding sample answers for banks. When a forward exchange contract matures and the customer gives no instructions whatsoever, after how many days from the maturity date does the Treasury branch automatically cancel the contract? A. First day from maturity. B. Fifth day from maturity. C. Third day from maturity. D. Seventh day from maturity. The answer is option C. Third day from maturity. When a forward contract is rolled over, cancelled, and rebooked, the old contract is cancelled at which rate? Option A, the original contracted forward rate. B, TT buying or TT selling rate prevailing on the day of cancellation. C, the weekly FEDAI average rate. D, the spot rate plus the premium applicable on the booking date. The answer is option B, TT buying or TT selling rate prevailing on the day of cancellation. In cases of automatic cancellation, forward contract on the third day from maturity due to customer's default or silence, what is the correct treatment? A. Exchange difference covered but swap cost waived. B. Only cancellation charges received recovered. Gains may be passed on as goodwill. C. Exchange difference and swap cost recovered but no benefit passed on to customer. D. The entire outstanding amount crystallized and credited to customer's account. Answer is option C. Exchange difference swap cost recovered but no benefit passed on to the customer. When the maturity date of a contract falls on a month end that is subsequently declared a holiday and it is a known holiday, what happens? A. Settlement is postponed to the next working day. B. Settlement is preponed to the preceding working day. C. Contract is automatically extended by 1 month. D. Customer must instruct the bank afresh from the date of holiday declaration. The answer is option B. Settlement is preponed to the preceding working day. Diary notes for reminding a customer of an outstanding forward contract should be taken how many days prior to the maturity date? Option A 7 days, option B 30 days, option C 15 days, option D 10 days. The answer is option C 15 days. Under the forward exchange contract verification guidelines, forward purchase or export may be made against a firm export order provided option A the letter of credit is unrestricted and the full shipment value is covered. B the foreign exchange offer does not exceed the proceeds of shipment made or the value of bills negotiated or sent for collection where shipment is already effected. B the customer produces a customs cleared shipping bill and DGFT approval. The advance payment has been received and credited to the customer's account. The answer is option B. The foreign exchange offer does not exceed the proceeds of shipment made or the value of bills negotiated or sent for collection where shipment is already effected. Uh, which category of persons resident outside India is prohibited from availing hedging for ECB external commercial borrowing designated in Indian rupees? Option A. Foreign portfolio investors hedging equity exposure. B. Any entity raising in INR ECBs as hedging is not permitted for ECB in an INR. CNRIs hedging FCNR balances. D. Foreign direct investors hedging proposed investment. The answer is option B. Any entity raising INR ECB as hedging is not permitted for ECB and INR. For a foreign portfolio investor, FPI, once a hedge contract is cancelled, it can be rebooked to maximum what extent? Option A, 25% of the cancelled contract value, B, 50% of the cancelled contract value, C, 10% of the cancelled contract value, D, 100% free rebooking permitted. The answer is option C, 10% of the cancelled contract value. Bank's periodic review of FPI hedge cover to ensure it is supported by underlying exposures must be conducted at least at what frequency? Option A, weekly, B, quarterly, C, annually, D, monthly. The answer is option D, monthly. Under the client eligibility CE framework, when a client's outstanding notional in a forward contract crosses USD 10 million, A, the client must obtain RBI's prior approval for all further contracts. B, the client must furnish the required underlying documents for all outstanding CE contracts as per norms for CE, and contracts booked under CE will follow CE rules thereafter. C, all existing contracts are automatically cancelled and rebooked under AE actual exposure norms. D, the client is exempt from documentary requirements for the remainder of the financial year. The answer is option B. The client must furnish the required underlying documents for all outstanding CE contracts as per norms for CE, and contracts booked under CE will follow CE rules thereafter. The client who has once exceeded the USD 10 million outstanding notional limit is option A, permanently barred from availing the documentary relaxation, B, not eligible to avail the documentary relaxation again during the same financial year only, C, required to obtain controlling authority approval for all future contracts for 1 year, D, required to maintain a 25% cash margin for all future contracts. The answer is option B, not eligible to avail the documentary relaxation again during the same financial year only. Under Model 1 of hedging trade exposures invoiced in Indian rupees, the AD Bank in India deals with A, directly with the overseas importer or exporter, B, the overseas bank correspondent, not directly with the end overseas importer or exporter, C, the RBI regional office acting as an intermediary, D, FEDAI's authorized settlement desk. The answer is option B, the overseas bank correspondent, not directly with the end overseas importer or exporter. Under Model 2, non-resident exporter or importer dealing directly with AD Bank in India for hedging in rupee trade exposure, the amount and tenor of the hedge must option A, not exceed 6 months irrespective of the underlying transaction tenor, B, not exceed the underlying transaction and be in consonance with extant regulations for payment and realization, C, match exactly with the letter of credit value and not the underlying rate order value, B, approved by RBI. D, be approved by RBI if the amount exceeds used USD 1 million equivalent. The answer is option B, not exceed the underlying transactions and be in consonance with extant regulations for payment and realization. In the context of forward exchange contracts for customers enjoying foreign bill purchase limits when booking foreign exchange forward exchange contract, the amount of contract should option A, not exceed the sanctioned foreign bills purchase limit plus 10% contingency, B, not exceed the unutilized portion of the foreign bills purchase limit, C, be linked to the import LC limit and not the export bills limit, D, be capped at the customer's net worth as assessed in the last credit review. The answer is option B, not exceed the unutilized portion of the foreign bills purchase limit. Our returns serve as a primary source of data on inflow and outflow of foreign exchange. India's obligation to submit balance of payment BOP statistics quarterly, to which international body makes accurate our returns critical. Option A, World Bank IBRD, B, Asian Development Bank ADB, C, International Monetary Fund, D, Bank for International Settlements BIS. The answer is option C, International Monetary Fund IMF. Our returns must be submitted twice a month, as on the 15th and the last working day of the month. They must reach RBI within how many calendar days from the close of the reporting period? Option A 5 calendar days, B 3 calendar days, C 10 calendar days, D 7 calendar days. The answer is option D 7 calendar days. If in any fortnight there are no transactions to report, the authorized dealer, option A, is exempt from filing and need not submit any return. B, must submit a NIL return within the prescribed time period. C, must submit a consolidated return from the previous two fortnights in the next cycle. Must submit a letter of explanation to RBI within 30 days. The answer is option B, must submit a NIL return within the prescribed time period. Bank-wide, our returns, Nostro and Vostro, are generated at the head office and submitted to RBI through which branch or system? Option A, Mumbai Overseas Branch via SWIFT. B, Bandra Kurla Complex Branch Nodal Branch via FETRS, FETERS, Foreign Exchange Transactions Electronic Reporting System, filed on RBI's BOP portal. C, Treasury Branch via the Finacle system. D, each authorized dealer branch submits independently to the respective RBI regional office. The answer is option B, Bandra Kurla Complex Branch Nodal Branch via FETERS, Foreign Exchange Transactions Electronic Reporting System, filed on RBI's BOP portal. Which of the following is the arithmetically correct formula for R return nostro? A, opening balance plus sales minus purchases is equal to closing balance. B, opening balance plus purchases minus sales is equal to closing balance. C, closing balance plus sales minus opening balance is equal to purchases. D, opening balance minus sales plus purchases is equal to closing balance. The answer is option B, opening balance plus purchases minus sales is equal to closing balance. Branches of authorized dealers that are not allowed to transact foreign exchange business independently but forex transactions through AD category B branches are classified under which category? Option A category A, B category B, C category C, option D category D. The answer is option C category C. A ready or cash merchant contract in forex dealing is deliverable A on the second succeeding business day on the following contract, B on the day immediately succeeding the contract date, C on the same day as the contract, D within a week of the contract date at the customer's option. Answer is option C on the same day as the contract. A spot contract is deliverable on option A the same day as the transaction, B the next business day after the contract date, C the second succeeding business day following the day transaction is closed, D the third working day from the date of the contract. The answer is option C, the second succeeding business day from the following day the transaction is closed. Maximum option period allowed under option forward contracts is option A 3 calendar months, B 1 calendar month, C 15 days, D 6 months. The answer is option B 1 calendar month. Foreign bills purchased or negotiated enter the exchange position. Option A, only after the bills are paid and proceeds are received in the nostro account. B, immediately as the firm rate has been quoted but affect the funds position only when proceeds are received. C, on the date of the relative shipment regardless of when funds are received. D, simultaneously affecting both exchange position and funds position at the time of negotiation. The answer is option B, immediately as the firm rate has been quoted but affect the funds position only when proceeds are received. Foreign bills sent on collection affect the fund's position first and the exchange position. Option A, simultaneously on the date of the bills are sent. B, when proceeds are purchased by the bank after being credited to the nostro account. C, on the date the bill is accepted by the drawee. D, when the customer's account is credited. The answer is option B, when proceeds are purchased by the bank after being credited to the Nostro account. Thank you very much for your patience. Please like and share this video and subscribe to my YouTube channel.